Welcome to the Capital News. I am your host, Alex Karitis. Today is December 10th, 2019. Thank you so much for joining me. Title of today's podcast is Over the Abyss. We're winding down the year 2019. Last year, we saw a massive market sell-off in the final months of 2018. Thus far, we have escaped such a repeat scenario, which would be very rare if it were to happen again. But last year, it was sort of a combination throughout the entirety of the fourth quarter, really picking up steam and momentum in December of that year. One of the main reasons for that sell-off was, of course, the Federal Reserve was increasing interest rates, and they were in the process of quantitative tightening. But in conjunction with that, and perhaps even more importantly, was the fact that there was not as much liquidity circulating in the market. And that is fact, what happens when you increase interest rates and when you embark on quantitative tightening. Now, interest rates need to be higher. Quantitative tightening needed to happen. The Federal Reserve needs to get back to quote-unquote normal within its balance sheet. However, the likelihood of that ever happening is slim to none, and Slim just left town. So now, as we have stated back in July, and we did a capital economics presentation on this, and you can find this on our website, The Capital News, or our YouTube channel, The Capital News. Are central banks trapped? Again, we were very timely here at The Capital News with that presentation, with that analysis, because in July, that is when the Federal Reserve cut interest rates for the first time in nearly a decade. A decade since the Great Financial Crisis. And that leads us to today's topic. Are we over the abyss? Are we staring down the barrel of another recession? Or perhaps, if things really get out of control, could this be not just a depression, not a great depression, but the greatest depression? I'm not saying this to be hyperbolic. I'm not saying this to scare you. I'm simply throwing out a scenario. And I don't just think personally that this is a possibility. I think it's a probability. Because you cannot have a problem back in the Great Financial Crisis of too much debt being solved over the course of the past decade with even more debt in even and ever-reaching corners of the economy. The household, the government, corporations, you name it. Everybody is overburdened with debt. Not everybody, of course, but most people are, unfortunately. Most institutions are, unfortunately. Who's going to bail them out? Even central bankers are overextended. They're trapped. They've been trapped because they never normalized. They were attempting to normalize here in the United States. We got to about, 2.25%, and the market said, oh no, we can't even have this. We cannot even tolerate in the United States of America, supposedly, the greatest economy ever in the history of the United States. Of course, this is not true. This is a daily lie. But that's the narrative. In the greatest economy ever in the history of the United States, we cannot even tolerate 2.25% interest. What's that tell you, folks? It tells you you're over-leveraged. It tells you everybody and every institution is overburdened and oversaturated with debt. And what is debt? It's future growth being brought to the present. So I don't even know how far into the future we have stolen people's prosperity. Younger generations who exist today, generations who have yet to become into existence. They don't even exist. They are going to have to pay the price of our actions and actions taken by previous administrations, previous Congresses, previous management in various corporations, you name it. And individuals, of course, as well. The consumer is not innocent of all of this either. In fact, if you really get down to it, you can blame the citizen and the average consumer because we're supposed to have a representative government here in this country. So perhaps the government is just a reflection of ourselves. It's not a pretty picture, is it? But nobody wants to stand up and take leadership. I told you, the only people who can be considered leaders in this world, at least according to me, are the people who are marching, protesting, and in some cases rioting. And they're doing so for themselves for their families, for their neighbors, for their countrymen, and for their country. People are sick and tired of it. This is not transitory, people. This is history in the making. It will be coming to a theater near you. The wealth inequality that exists, the nepotism, the corruption, the lies, the abuses of power. People are fed up. They are sick and tired of what has grown up around them on their watch. And everybody wants to point the finger at somebody else. People are sick and tired of it. They're overthrowing their governments, and that's still not enough. People are tired of being squeezed for their last dollar, their last dime, their last nickel, their last penny. Tired. You can't increase taxes on fuel. You can't increase a fare rate for the metro, for the bus system. Nothing. That's the final straw. You can't redo pensions because, once again, they're marching and protesting in Paris or all over France, really, because President Emmanuel Macron is trying to redo and reorganize the pension system over there. This is where you are. You're in between a rock and a hard place. What to do, what to do, what to do. Well, nobody wants to stand up. Nobody wants to step up to the plate and be honest with the people. Definitely not here in the United States. We have a Federal Reserve that's printing money like it's going out of style because it is going out of style. We have a president who lies on a near daily basis when it comes to the economy. And if not him, it's one of his lackeys within the administration or one of his children, who I also feel compelled to tweet at when they come out with those remarks, saying that this is the greatest economy ever. And what do they point to? They point to the unemployment rate. They point to 401ks. That's really not enough, folks. It's really not enough, because those 401ks, the stock market going up, is because of the funny money that is being printed by the Federal Reserve, not because of organic growth here in the United States. Because there isn't organic growth here in the United States. We're stealing it all from the future. Again, how many generations are we screwing over here? I have no idea, but I guarantee you it's more than one. It's likely at least two, maybe even more, depending on what we do when this next crisis, when this next recession hits. Will it be a minor recession, or is it going to be something like the Great Financial Crisis? May it be even worse? It depends on what we do. Right now, I can tell you the policies that we appear to be adopting are not the solution. In fact, it's creating more of the problem. It's keeping these zombie companies alive. We talk about this here all the time. We talked about it yesterday. And I don't want to sound like a broken record, but this is what you have to stay focused on. You want to stay focused on all of the hype of all of the politicking and everything else that's going around, the circus in Washington, D.C., whether it's with the Democrats, the Republicans, the president. Go ahead. Be my guest. We talk about those things here. Yes, we do. Because they are all interconnected. The health, the security of our republic is at stake, so we talk about those things. The institution of democracy and of our self-government is at stake here because of these buffoons who are running around pointing the finger at everybody else and not taking responsibility, using the Constitution when it's convenient for them to do so. When it's not, they all trample over it. That's Democrats and Republicans alike. That's Obama, that's Trump, that's Bush, that's Clinton. It's all of them. So get your head out of your you-know-where and focus on the truth and focus on the justice, and stay focused on the core problem, which nobody wants to talk about, and that's the Federal Reserve. You have to understand, everybody, when you go shopping for something, you're making an exchange. The money in your pocket for the goods or services that you are buying. That means that money, those dollars, that currency, is 50% of every single transaction you make. Have you ever thought of it like that? You go to the store, you buy bread and eggs. You get bread and eggs. The grocery store gets your cash. 50% goes to you, 50% goes to the store. That's the trade. That's the trade. You understand how important it is that value of the currency, how important that is to you? And why I get red-faced and start fuming when we talk about negative interest rates? And right now, they're in Europe and they're in Asia. We're not in Europe. We're not in Asia. We're here in the United States. But when you have a president who is calling for negative interest rates, and I understand what that means, and hopefully you do too, especially those of you who have been with me for a while, I want that money. Give me that money. It's your money coming out of your pocket. out of your retirement. Is that okay with you? Because where's it going to go? Is it going to go to build massive infrastructure projects? I don't think so. We haven't seen anything like that in years. Is it going to go to curing AIDS, cancer, Alzheimer's, Parkinson's, world hunger, homelessness? I don't think so. I don't think so. So where's it going to go? So even if you were to say, well, we're giving the government all this money, and we have such spectacular things. We have infrastructure that takes us from coast to coast in a matter of a couple hours. Safe, efficient, affordable. Nope, we don't have it. We don't have it. Cures to cancer, a whole bunch of other diseases. Nope, we don't have it. The best K through 12 education system in the world. Nope, not even close. Not even close. So why do you want to give these buffoons even more of your money? I hope the answer is you don't. I hope that's the answer. And again, that's why the solution to our problems, or at least in large part, a big stepping stone, a foundation, is to abolish the Federal Reserve and to abolish the federal income tax. You want a pay raise? Just keep what you're earning. Just keep what you earn, 100%. You will instill a consumption tax. And I'll have to do a podcast separate to that with we'll call it the Coritis plan for the United States of America. My goodness, wouldn't this be prosperous if people listened to me? Over the abyss, people, that's where we are headed. Now, we're going to get somewhat into the weeds today. I don't like to get overly technical here, but we have to discuss some of these things because the Federal Reserve is meeting today, and they are meeting tomorrow, and tomorrow they will render their decision on interest rate policy. All eyes and ears are going to be on the Federal Reserve, as is the norm when they have a meeting, which is also the case when you have the ECB and the Bank of Japan. But the granddaddy of them all is undoubtedly the Federal Reserve. So what took place in the markets today? We have the Dow Jones Industrial Average down about 38 points. The S&P 500's down 7 points. The NASDAQ 100's down about 18 points, all down about 0.2%. As the time of this podcast, the Asian markets are open. We have the Japanese market relatively flat. Shanghai, the Chinese composite, is slightly up. And Europe was a mixed bag throughout the trading session today. On a commodity front, oil is still at $59 a barrel for WTI. The international metric of Brent is at 64, still holding pace. Gold and silver, relatively unchanged from yesterday's podcast. Gold is at $1,462 an ounce. Silver at $16.64. Now, what I'm about to discuss here goes right back to my belief that these precious metals, gold and silver particularly, are in a bull market. Because I think the system is running on fumes, and the system runs on trust and confidence. So we have to place our trust in a president and an administration who lies on a daily basis. We have to put our trust and confidence in the Federal Reserve, who doesn't know their you-know-what from their elbow. And we're going to get into even more of that, I suspect. And we have a Congress who seemingly can't get anything done. And we have a consumer and a general populace who is more concerned with the basketball score, with the football score, with Dancing with the Stars than they are with these problems that affect everybody. Now, I would be happy if everybody was able to focus on the basketball score, the football score, Dancing with the Stars, if I didn't have to pay for all of this abuse and corruption. I wouldn't care less. I'd say, thank God that's what you're focusing on. Don't focus on all of this boring technical jargon. Now, of course, to me, it's not that way, but to most people it is, and I understand that. But when you don't pay attention, and these criminals can get away with the crimes that they do, and it affects me, I have a big problem with that. You want to give these idiots your money? Open your pocketbook, write them a check, swipe your card, do what you want to do. Don't reach into my pocket to pay for your problems. Don't do it. So that's why I have a beef with all of this. That's why I do this podcast. If I didn't have to pay for all of this, if this wasn't going on, I wouldn't be here. I wouldn't be discussing these things. I'd be as happy as a clam. I wouldn't have to worry about this stuff. That's why I discuss it. That's why I want you guys involved and educated on this matter too. So the trust and confidence in an administration that lies, and this is not just the Trump administration, this is previous administrations too. It's a Federal Reserve that continues to lie. And then the banking system. Oh yeah, those good people. The good people at the banks that just continue to consolidate their power and their stranglehold on industry. We are in the midst and have been in the midst of the financialization of the entire economy here in the United States. Really globally as well, but most definitely here in the United States, because we are a mega financial center. I mean, as much as you can talk about China being the second largest economy in the world, they're not even close to us. They're not even close. And if they go through what I expect that they're going to go through, it's going to take them one hell of a long time to catch up, if they ever do. If they ever do. It'll be a long time, believe me when I tell you. And it's not going to be good for us either. But at least we have a better system of law and justice here to some degree. People who still believe in our Constitution, thank God, there's still enough people out here, because it doesn't take a majority to restore it and to stand up for it. In fact, it's usually a minority that does that. So we'll see what happens. But we got to place trust and confidence in these characters. And I don't know about you, but I don't feel like placing my trust and confidence in them. So what's also interesting to note, and as we were discussing at the top of the podcast, the end of the year, and of course December in particular, is a very trying time for many corporations, many businesses. It's year end. Got to get your numbers together. Got to pay taxes. So you need a lot of cash. There's a lot of cash outflow going to Uncle Sam. Remember what happened back in September? The Federal Reserve came out and said, oh yeah, the overnight repo market, the overnight lending markets, yeah, they kind of seized up. There was kind of a problem. But don't worry, folks, it's just a one-off. You know why it's a one-off? Because it's tax time. It's the end of the third quarter. And Uncle Sam with the Treasuries, there were some things that were coming due, needed to roll over some paper. So we just had to intervene. It's just a one-off. It's just temporary. We said, no, it isn't. We called BS. And of course, we were right once again here at the Capital News. And I said, look, this is the beginning of something major on the horizon. I said, I don't know what it's going to be. I don't think anybody does. I don't think the Federal Reserve does. I just think that the Federal Reserve knows that something is coming on the horizon. Because when you have these overnight markets not clearing, that is to say, buyers aren't finding sellers, and that's why the Federal Reserve has to intervene to make sure that these markets clear, you got a problem. This is what I have been warning about for years. For years. Now, this podcast has only been on since February, but I have this in writing in our book, The Cynic's Guide to Investing, which was published in 2015. I said there was going to come a day of reckoning if our policy makers did not grab the bull by the horns and right and ready this ship. I said the market will have a field day with this economy, like it always does. The market always wins because the market is more powerful than all of us. It's more powerful than all of our institutions. Can we continue to kick the can down the road? Sure can. Can we continue to pump this thing with monetary methadone, with all the crack cocaine that keeps these people happy? Sure can. But you cannot defy the laws of economic gravity forever. You just cannot do it. Diminishing marginal returns will kick in at some point. They already have, in my opinion, and in my analysis. I thought they would have had a more negative effect at this point, but they haven't. So that just gives you the idea as to how strong and powerful the Federal Reserve is, or maybe, on the other side, just how stupid people are, or just how indifferent and agnostic they are to caring. And I don't really mean the general population, because the general population doesn't even know what the Federal Reserve is. Don't know who Jay Powell is. Don't know what the Federal Reserve does. Talking about overnight repo markets, they're not going to have a clue. I'm just talking about the crackheads on Wall Street who don't care about the upstream, midstream, and downstream effects of their actions. They're just there to make money at any cost. Well, we saw what happened when people go out to make money at any cost. You have a great financial crisis, and another one is lurking. And I think the reason why another one is lurking is because of what is taking place in the repo market. Could this be banks on the precipice of falling into the abyss? Collapse, bankruptcies? Could this be hedge funds on the edge of the precipice, ready to go into the abyss? All I know, and I believe this to be true, at least to some degree, and again, citing that report from the Bank for International Settlements, BIS, some people refer to it as the BIZ, when they came out and said 6% of all non-financial companies are zombie companies. I said, well, there you go. There you have it. That's what's going on right now. That's why you have the overnight lending market seizing up. That's why you have the market saying, no, we're not going to lend money on an overnight basis at the federal funds rate or anywhere near it. 1.75, 1.5%. Nope, not even close. You owe me 10%. I'm not making this up. You can look up the data. You owe me 8%. This, folks, is never supposed to happen. The Federal Reserve is supposed to be in complete control of this market. They set the rate. That's what it's supposed to be, somewhere in there. It's not supposed to spike by a factor of 5 or 6. Not even close. But that's what happened. That's what happened. They have greater control over it now because why? Well, they've started on quantitative easing once again, but we're not supposed to call it that, of $60 billion per month. They do overnight lending. So there's pretty much no market. It's just the Federal Reserve doing all of this to the tune of perhaps $120 billion a night. And then you have the temporary market, repo market, which is extending, I think, for a month and a half, something like that. And that's up there to the tunes of tens of billions of dollars, $40, $50 billion as well. Now, do they know the heart and soul of this problem? I don't believe they do. I just believe that they know there's a problem on the horizon, and they're doing what they can do. They're a carpenter with a hammer. Everything looks like a nail. So they don't know which one's actually the problem, but they're going to print as much money as they possibly can. They're going to throw as much liquidity out there into the system as they possibly can. And when you look at the Federal Reserve's balance sheet, it has increased at an exponential rate, which we also predicted was going to happen here at the Capitol News, because I said, look, if they're going to reverse course from quantitative tightening and increasing interest rates to quantitative easing and lowering interest rates, which is exactly what they've done and will likely continue to do, that they are going to have to put the pedal to the metal like we've never seen before if they really want to have an effect this time. Why? Goes right back to diminishing marginal returns. Again, as a quick example, diminishing marginal returns for those of you who might not be familiar. Say you're thirsty. I give you 6 bottles of water. You down the first 2 bottles real quick, it quenches your thirst. By the time you get to the 3rd, 4th, 5th, 6th, you're dying. You say, no more water, no more water. It no longer has the effect that it once had in those first 2 bottles of water. Same thing here with money printing. It was an experiment that was tried a decade ago in the depths of the financial crisis, and people said, oh, okay, all right, well, we'll trust these people, the same people, by the way, who caused the problem, but we'll put that aside. All right, well, maybe these people, all right, they broke our legs, but they're giving us crutches, so maybe it's going to work out. Maybe it's going to work out. It was new. It was the first bottle of water. And, okay, it had a stabilizing effect. Okay, maybe they're going to pull this out. Maybe this is going to work. Okay, baby, let's keep it moving. And then there's another dip. And then they come back in with quantitative easing number 2. And then it ramps up again. Oh, everything's fine. We're reflating the assets. We're inflating everything. Everything's fantastic. They saved us once again. A little bit more time goes by. Market dips again. Then they do Operation Twist. Then they do QE3. And then they just go stagnant for a while. And then they do the quantitative tightening. It started to wear off, is what I'm trying to tell you. Diminishing marginal returns kicked in. And they kicked in on overdrive last year. Liquidity seized up. There was not a market to be had. I believe, if memory serves me correctly, there was zero issuance of any type of junk bond, high yield debt during the month of December in 2018. That's virtually unheard of. But that's what happened, because there was nobody who was going to take that risk. There was nobody who was going to throw that money out at these companies who are high yield, who have junk status. Well, not only do we have companies with high yield and junk status, we also have the leveraged loan market out there, outstanding. So that's a loan on top of a loan. People paying debt to pay off debt. You get the picture? You think this is sustainable? Is this the type of economy you want? Built on debt, built on funny money, built on lies and fantasies? Because let me tell you something, folks. A lot of you, I'm sure, can remember back a decade ago to the great financial crisis. Some of you can remember back to the dot-com bust. NASDAQ losing 80%. This wasn't that long ago, folks. This is what happens. You get drunk, you get a hangover. But the more you throw into the system, the worse it's going to be on the other side. That's why I'm saying let this thing clear. Let the market have its way, because it's going to one way or the other. But the sooner we can allow these malinvestments to be liquidated, and it doesn't necessarily mean that these companies have to go out of business, although I presume many of them would. They can go through bankruptcy, they can restructure, and maybe they can come out stronger. I imagine, though, that many of them will go by the wayside, and that's fine, because you need productive resources in the economy using the resources that exist within the economy of capital and labor. If you have somebody who's a poor entrepreneur or a poor manager, it doesn't mean that they're always going to be a poor entrepreneur or a poor manager. They can acquire better skill sets. They can learn from going through these types of events and come out stronger on the other side. Maybe they got to go through with another company, and then they can go back on their own again. But you can't keep these players in business just because it's politically expedient to do so. Because there's somebody else out there who's a great entrepreneur or who is a great manager who would love to have those extra resources of capital and labor, but they're being used up by the idiots, for lack of a better word. It's not good, folks. It's not how you're supposed to have a well-functioning economy. And guess what? You know how this happens? When you have a controlled economy. This is not a free market economy. This is not free market capitalism. If it was, prices would have collapsed months ago, years ago. If this was a free market capitalistic system, the banks that crashed a decade ago, they would have been gone or completely downsized. Completely. But they were rescued by a system that thrives on them, that are joined together at the hip. Big business and big government. We talk about it through the entirety of our book, The Cynic's Guide to Investing. Buy it, by the way, why don't you? Because it's a great stocking stuffer for the upcoming holidays. Learn something. Add it to your library. Because that's the system in which we live. That was the system that was saved. Not you, not the savers, not the people who were doing the right things, not the homeowners. No. The people who screwed over the system, they're the ones who got rewarded. They're the ones who got the bailouts. And they got to make the profits when they were going up, too. It's not a good system, folks. It's not worth being saved. It's not worth being salvaged. But the lower we go with these interest rates, the more money printing that we do, we go into negative rate territory. All this is going to do is perpetuate this system, which needs to be gone. It doesn't need to be tweaked here or there. It needs to be abolished because it's not working for the many. It's working for the few. And that's exactly why you have wealth inequality to the degree in which it exists globally. Globally. It's very easy to follow along once you understand the internal plumbing. So to get to an article I came across today on my Twitter feed, it was an article from Zero Hedge. Many of you may be aware of this if you follow some of the financial independent media out there. Zero Hedge is by far one of the ones that's probably going to be up there in your top 3 or 5 sources that you'll come across. And I don't want to get too technical here because I'm not an expert on all of this internal monetary plumbing either. But needless to say, the article discusses the opinion and analysis of somebody who is a monetary expert. And this is an analyst within Credit Suisse. And he is basically saying that we are staring over the abyss. That what is taking place right now is not good. That what happened last year in December and in November and October, all of that can happen within the last few weeks of 2019. There's only a couple of options that the Federal Reserve and some other central banks can do. And neither of those are likely going to happen. Because the Federal Reserve is very unlikely tomorrow to come out and say, yeah, we're going to start doing quantitative easing again. Because the Federal Reserve wants to say this isn't quantitative easing because they're buying short-term bills. But if they go further out on the Treasury duration curve, buying 1-year, 2-year, 3-year Treasury bills or notes, then that would be quantitative easing. But because they're just buying short-term bills right now, it's not. Now, okay, you want to splice words, play semantics, whatever. I'm not buying it, but at least that's sort of the distinction that's being made there. So the Federal Reserve would have to come out and admit that they have to embark on quantitative easing number 4. And what message would that send to the markets. Because we're sitting here in a 50-year low on the unemployment rate, and we're told that inflation is virtually non-existent. And we're told that by the Federal Reserve, and we're told that by President Donald Trump and his administration. Well, guess what, folks? The Federal Reserve has a dual mandate. Low unemployment, or full employment, I should say, which is the same thing, low unemployment, as low as you can go, and price stability, which theoretically would mean very low inflation. Well, they check off both boxes. And both the White House and the Federal Reserve say that this economy is strong. It's in a good place. So why would they have to embark on a emergency monetary policy, such as quantitative easing? Why would they have to continue cutting interest rates if everything is spectacular? They're walking contradictions. This is the system that you have to place your trust and confidence in. I don't place my trust and confidence in this system because I don't trust these people. I don't have confidence in these people. These are the same people who put us into this mess. And now we're supposed to think somehow, miraculously, they're just going to pull us out of it by doing the same exact thing that led to the problem? That is the definition of insanity. You want to go bet the farm on black or red coming out, be my guest, but good luck to you because you're going to need it. The same thing as placing your trust in these people. And that's, you got 50-50 basically placing it on red or black at a roulette table. These people, I think you're screwed. You're done. This is like betting on green. Yeah, you got a chance. I don't think so, though. Probably not the smartest move. So this is the analyst at Credit Suisse. And if you can find the article on Zero Hedge, I would recommend it. It's a lengthy read, and it's going to get very technical. You might have to reread it, and that's fine. But I think you'd learn quite a bit. Because this is just a series of things that have been put into motion by the Federal Reserve and other policymakers and other central banks around the world. And with the quantitative tightening and with pulling liquidity out of the system, because the system is now so dependent on this liquidity that it cannot survive without it. That goes to our point earlier where the economy couldn't take, the stock market couldn't take, neither, because the stock market and the economy are not one and the same. They should be much more closely linked, obviously, but they're not right now. It's a complete decoupling. But nevertheless, the stock market nor the economy could handle 2% interest rates, 2.5%, 2.25%. Okay? That's how fragile the system is. That's why we're on the edge of this abyss. I believe this to be true. That's why I tell you to stay diversified, because we've been in a melt-up. We have been. And if you look at the Federal Reserve's actions, how much liquidity they have thrown into the system, if you look at their balance sheet, if you look at corporate debt, because that's where most of it's headed, it's basically a one-to-one relationship. When it comes to debt increases, and lo and behold, so does the stock market. The Dow Jones goes up, the NASDAQ goes up, the S&P 500, they all go up. They all go up. Because debt is going up, because the printing of the funny money is going up. This is not real. This is all an illusion. It goes up quick. The saying is that, you typically you take the escalator up and you take the elevator down. Well, guess what, folks? That's exactly what we saw a decade ago or 2 decades ago during the dot-com crisis. And when you look at valuations, when you look at something as market cap to GDP, it's at near record highs. It's at near record highs. And this is something that Warren Buffett likes to look at. Market cap of the stock market to GDP. It's just a simple valuation metric. And we are near where we were during the dot-com bust. And I will remind you that the NASDAQ lost about 80% over the course of 2 years during that massive correction. Because you had a whole bunch of companies that were being, trumped up, if you will, that they were going to make massive, massive amounts of money, and they never did. Pretty sort of very similar to what we see here today with the likes of Uber and Lyft and a whole bunch of other tech companies and the like coming onto the stock market with their IPOs, not making money. It's the same thing. It's all hype. It's all marketing. That's the world in which we live. I'd rather live in the real world. I would rather live with people and our elected officials and quote-unquote leaders telling us the truth and coming to terms and coming to grips with everything. I would have preferred if Donald Trump came in to truly drain the swamp and was an honest steward, an honest president, but he is not. I would have appreciated it if he had risen above all of the divisiveness and united the country and said, you know what? There are more important things in this country and in this world and in this life than GDP figures and how high the stock market is. But that's not Donald Trump. He is Mr. Materialism. That's what he's all about, and himself. He could have came in and he could have said, we're not going to worry about those things. We're not going to worry about GDP. We're not going to worry about unemployment. We're not going to worry about the stock market. We're going to take care of each other. We're going to take care of this country because it has been ignored for far too long. We're going to take care and restore our Constitution because it's been trampled on for far too long. He didn't do it. Neither did the Republicans, nor have the Democrats. He didn't do it. He had the opportunity of a lifetime. Winning an election nobody thought he would win. He had a mandate. He could have done it. He didn't. And he's not. He could have put aside all of the materialism, all of the consumerism, all of the debt, all of it. He could have said, here's what we're going to do. We're going to straighten this ship up. We're going to turn it around, put it in the right direction. If the stock market goes up, so be it. If it doesn't, so be it. GDP goes up, great. If it doesn't, that's fine too, because we're cleaning house. We're getting better. But that's not what's been said. We have trillion-dollar deficits. We have manufacturing, transports, retail, construction in contraction. We had a major trucking company, Celadon, file bankruptcy. About 3,000 drivers now out of work. Transports leads, ladies and gentlemen. That's why I talk about the Dow Jones transports and other leading economic indicators. It starts in transports because things have to get from point A to point B. And when that's slowing down, well, guess what? These companies go out of business or they got to file for bankruptcy. And they were seeking capital and nobody gave it to them, which is the same thing that's going on in the overnight markets. Nobody's trusting anybody. This is a system based off of trust and confidence, and nobody knows the system better than the crooks and criminals behind the scenes. Nobody has a better understanding to the degree of the corruption that exists than those people, those institutions. So when they're not trusting each other, look out below, over the abyss. Stay diversified, stay vigilant, and stay with the Capital News. Please like, share, subscribe, get your word out. Leave your comments. We do love hearing from you. This is the Capital News. I am Alex Koritis. Godspeed.